2025 has been a very interesting year, especially in private markets. And more retail investors are being encouraged to get to grips with the asset class. Here, we're going to bring you the expert framework for assessing the space. Through it all, Blackstone has thrived, deploying 123 billion in the last year alone, give or take, and Jon Gray has been at the center of these decisions. So here, he's going to share how Blackstone sees through the hype and the panic, often typical of public and private markets, to help us all understand how to think about those opportunities in what's typically called alternative investments. So, Jon Gray, welcome to the Modern Investor Summit.
Great to be with you, Carl.
Fantastic. Let's dive right in, because not too long ago you published something called "Everything is in a Bubble." So let's start there. Is everything in a bubble?
I think we tend to use the bubble term a little too liberally. If you went back to the classic bubble of tulip bulbs in the 17th century, prices went up 10, 20-fold in a few years. If you went back to the dot-com bubble, you had the biggest companies trading at huge multiples. I think Cisco, the largest company, was trading at 130 times earnings.
Yeah.
If you think about today, NVIDIA, the biggest company, they're trading at less than 30 times earnings. So it doesn't mean that there aren't at times excess prices, but I think we're just so quick to call things bubbles. And I think there is more risk when you have transformative technologies emerging. If you go back to railroads, if you go back to electricity, the internet, these things can run too far, too fast. And there could be individual companies today, misallocations of capital, but to aggregately look at what's happening and saying this is a giant bubble, that just feels like too much. And I'd say the same thing about the stock market. It's trading a few multiple points above its historic averages. But if you think about interest rates coming down, pretty resilient economy, and this technology change, that feels actually maybe fully priced, but not a bubble sort of thing. And I'd say the same thing, a lot of discussion about private credit. And there again, default rates are actually low by historic standards. So it doesn't mean that people aren't making mistakes, couldn't lose money. But when you get to this idea of bubbles, to me, that's when things have sort of become unglued and prices make no sense at all. And that's not the world we're living in today.
Got you. So if I think about, a framework almost, if we can give people for identifying a bubble from maybe a richly valued opportunity set, I guess valuations are one thing to look at. Transformative technology, is that sort of the way to think through it?
I think it's valuations. It's often leverage. If you went back to the subprime housing crisis in the U.S. prior to the financial crisis, I mean, that was caused by just very, very high levels of leverage. It is when you begin to see companies valued on revenue multiples, when you just see tons of capital that sort of, and unproven business models too. And there's sort of a frenzy and things become, unmoored from reality. And again, it doesn't mean that some investments may not be bad. There certainly are some companies who may be making excessive financial commitments or may turn out to be pets.com type businesses. But when you look at it aggregately, I think the picture today is much sounder than sometimes what you read in the newspaper. And back to your opening comments, I think having a little bit of a longer term view of what's happening can be very helpful as investors.
Okay, that is super helpful. Now, I think that will help maybe calm some nerves out there, but there is uncertainty out there. And I think you said in the past that, today's uncertainty is unlike past economic cycles. So, what makes this cycle different and how do you think about navigating it?
Well, I'd say a couple things are different. One is the last few cycles we've been through, as the economy slowed, the Fed responded by lowering interest rates.
Yeah.
And that helped to recover a recovery in asset values. In this cycle, because we had an inflation shock, which we really hadn't had since the 1970s, the Federal Reserve and other central banks, including in the UK, have held rates generally higher for longer. And so that's made the cycle more difficult in some ways to navigate. The other thing is, I think the technology change here is very profound. So today, we've been talking a lot about bubbles. Yes, we should be worried about valuations, but I think equally, if not more, we should be worried about disruption. So
Mm.
people are looking this way. They should be looking over their shoulder saying, well, what happens if autonomous vehicles really take hold? I took
Yeah.
a few Waymos a couple weeks ago, and it was a great experience.
Yeah.
Well, what happens to auto repair shops and auto insurance companies and the multiples they trade at as that becomes a bigger part of the market and accident rates fall? What happens in coding and customer engagement, content creation, lots of rules-based processing businesses as this disruption starts to work through the economy? And so to me, that's probably the hardest part of this cycle and the thing we're spending the most time on. We recently had a global partners meeting and we had a CEO conference as well. And we spent so much time talking about the risk of disruption. How do we avoid some of the challenges? How do we think about our existing portfolio? How do we capture the benefits going forward? So that would be the other thing that I think is very difficult for us as investors because we all think sort of linearly. And I think
Yeah.
we're on the cusp of this step function change in our economy and the way we live our lives and businesses function. And that's very hard.
I'd love to maybe pull back the curtain on that piece around the partners meeting, the CEO conference, and get a bit more about, those sorts of conversations. Because if I just take Blackstone on its own, 1.2 trillion portfolio, you're in rental housing, you're in logistics, you're in so many parts of the economy, and then the CEOs that you bring together as well, you're going to get clues, you're going to get data points around where disruption is pinching, where it's working, where it's not, way before it hits the official stats, the government stats, at which point it's too late. So what can you share from
Yeah.
those rooms?
Well, what I would say is it's interesting. I think the technology today, the large language models are very powerful. And
Mm.
the pinch point today isn't actually the technology, it's the application.
Yeah.
Getting it to the companies, having them change their processes. It reminds me a little bit in the medical field, you have great basic science, but you're struggling how to get it to the patient into
Yeah.
a clinical setting. And I think that will change. Where the impact is clearly the most profound is in coding. I mean, these tools make our software engineers, both at Blackstone and our portfolio companies, much better. We're definitely seeing all sorts of tools in terms of data collection and organizing data, sharing that data. Those are very powerful things.
Yes.
On the content side, as I talked about, we are seeing the ability to create music and movies and clips and commercials. It's still early days. I would say where we're struggling a little bit is some of the processes where there's a human element, where we think over time in accounting or compliance that we can make human beings much more productive, but
Yeah.
you really have to train the models and the people. So it's
Yeah.
not like you just plug this stuff in. And so I think the hard part is taking some sort of complex process we do that ultimately a large language model could be highly efficient and making that a reality. And
Okay.
I would say my gut is that it's definitely going to happen, but it's going to take the right application software and it's going to take the right people who take this software and bring it into the real world. And that right now is still taking some time. But what I would say is the enthusiasm of the CEOs to do this is remarkably high. People want to make their businesses better. They want to make the customer experience better. They don't want people waiting on hold for answers, take the friction out of so many businesses. But I would say we're still in the early days of this, with the exception of coding, where that is really on the flywheel.
Okay. So that's super interesting. And you've answered my next question, which was around how to think about the hype around AI and how you're going to get fundamental value out of it. But I guess what you're talking about is actually seeing these things work inside businesses. And maybe the difference, if I can draw a parallel versus .com or pets.com, was there were a lot of high level vanity metrics that the .com was goosing up. I remember EV eyeballs as evaluation metric, whereas here we're talking about actually getting into the business and cost saving, productivity gain, that sort of thing.
Yeah, and creating new experiences for
Yeah.
customers as well. I think the reason why the potential prize here is so large is, if you think about it, there's $60 trillion of annual labor spend around the world.
Okay.
If you can make labor 15% more efficient, more productive, and so you can do more as somebody who's employed, 15% is $9 trillion a year. So
Yeah.
when you think about the investments today in data centers and in power, maybe it's not so irrational because
Yeah.
the potential upside is so large. And I think that's the thing people are losing sight of, back to our earlier conversation around bubbles, is that
Yeah.
you can really impact, improve businesses, improve customer experiences, improve productivity. And that's when you see big gains. And if you go back to the mid 90s, when we brought the internet on, we tripled productivity growth in the United States. And of course, that led to faster economic growth. Markets did very well. Ultimately, it went too far. But I think the potential size of change here is so massive. That's why I think the investment is actually quite rational.
Okay. And you bring me very neatly to a question on data centers, because Blackstone is the largest private data center investor in the world. You've explained why that makes sense. I guess maybe a couple of questions there. We talked up top about timelines and being really long term. Is this a 5-year bet? Is this a 10-year bet? How should I think about that? And maybe the follow-up question there is, if I was sort of playing around with some data and it looks like, your rents have grown astronomically, vacancies are tiny. At some point, Blackstone's not the only smart group of people in the world. Supply catches up, margins compress. So I guess, yeah, same question. Is this a 5-year? Is this a 10-year view? How should I think about that?
Yeah, well, I think you start with, we're talking about this transformative technology, and what we've been trying to do is find ways to invest capital at scale and deliver great performance for our customers. That's the most important thing.
Okay.
And even though we're super excited about the technology, we, like everybody, want to protect our downside. So we've really focused on the picks and shovels, right? If you go back to those gold miners in San Francisco in the 1850s, what the ones who said, hey, instead of going for gold, I'm going to sell picks and shovels to the miners, that turned out to be a really good business model. So in this case, what are the picks and shovels? It's obviously the chips, it's the data centers, and it's the power. In the data centers in particular, which you've raised, what we're doing is we're only doing construction when we have a long-term lease from one of the biggest companies in the world. So we get a 15 or 20-year lease with a major hyperscaler. And that gives us downside protection. And then we put the enormous amounts of capital in the ground. So it's what I think of as a very safe way to play this trend. And if some point, demand for data centers goes down, then we would just stop manufacturing new data centers. It's different than if you think about buying condominiums in Miami or Dubai, which are built speculatively. When prices run up, then the market softens, and then you're stuck with a bunch of unsold inventory. In this case, you're only investing the capital when you have that long-term lease. So that's the approach. I do think, because the demand for compute power is so significant, and the data centers, the AI factories, as Jensen calls them, are so essential, I think the need will be very significant. So I don't think we're at the end of this run. I would add to this that the other area that's quite exciting is the power. Because
Yes.
if you think about the data centers, if you think about the robots that are ultimately coming, if you think about the autonomous vehicles, they all plug into the wall.
Yeah.
And so the amount of energy we need is going up massively, and so if you can invest in generation, transmission, utility services, electrical equipment, that's another area of the picks and shovels we really like a lot. So we're trying to support what's happening. We are making some more speculative investments in the growthier part of this, the application layer, the LLMs. But on a relative basis, the big dollars we've been deploying have been in these picks and shovels area. And because I think this massive build out will continue, we think it's a sound way to do it, a downside protected way to do it.
Fantastic. Okay, that's super clear. All right, I'm going to switch gears. Private credit. Your private credit business is something like 3x in the last 5 years. Great moment. Commentators from here to wherever say retail investors need more exposure to private credit. Now, the critics would argue it's the next subprime, it's opaque, it's overlevered, it's therefore not suitable for retail, and it's probably going to blow up. Why are the critics wrong and Blackstone right?
Yeah. So I would start with what private credit is. It's basically the idea that we take investors, and by the way, it's not just individual investors, it's insurance companies on the investment grade credit side, it's institutional investors, and we bring them right up to the borrower. And in the process, that direct to customer model, farm to table, knocks out a bunch of origination costs, securitization costs, financing fees. And so the investor ends up getting a higher return. They trade away some liquidity, but they get a higher return for the same risk. And so to me, fundamentally, delivering that package directly to you as opposed to going through a distributor in the middle or a retailer makes a lot of sense. That's essentially what you're doing at its core. And so the question is, have private credit participants been taking on a lot of risk doing this? On the one hand, we run our businesses with virtually no leverage or very modest leverage. So from a systemic standpoint, that's very safe. And then when you look at the underlying loan to values, they've been really low. So in non-investment grade credit, we've been lending in direct lending on average around 40% of the total purchase price somebody bought. So there's 60% equity going in there. If you went back to the frenzied period in credit of 06, 07, direct lending, other forms of credit were 80%. So part of the reason you're seeing these very low default rates is because there's not a lot of leverage in the system. So, and the other thing I'd say back to that point is the proof sort of in the pudding. Look at the default rates out there. They remain incredibly low. And so if you went back again to bubble periods in credit, to housing in 06, 07, you were seeing default rates skyrocketing up. That's not what we're seeing today. And so, again, whenever you have a shift in a marketplace where one way things were done using just financial institutions, and now we've created a new source of capital where an underlying investor can get a higher return but not take on more risk, people are like, hey, what's going on? Is there something excess in the system? We would just say this is a new, more efficient way to deliver credit and deliver investment opportunities. So we feel really good about it.
Okay, that is very fair. Okay, I'm going to switch gears again, just because we spent a fair bit of time talking about AI, gets tons of headlines, justifiably so, but you've also talked about other themes, to name a few: life sciences, which we touched on a little, secondaries, real estate. Could you maybe give me the elevator pitch on each of those, why they matter, where you see the opportunity?
Yeah. So in life sciences, I think we're going to see an acceleration in the pace of innovation just because the technology will enable a lot of that. And yet at the same time, There are pharmaceutical companies who have to focus on their earnings growth, their liquidity needs, how much R&D they spend. So they would like to find partners in that area. And then life science companies are reluctant to sell equity in their business because they think they have a great underlying therapy. And so they're looking for partners. So I think this will be technology accelerating the discovery and innovation, and yet you still need a huge amount of capital to bring these drugs ultimately through clinical trials. And that's where we tend to focus in that area. And so we think there's a lot of runway in that space. On the real estate side, what I'd say is there's no bubble in real estate. It's been a very tough 3.5 years in commercial real estate. Prices have actually come down a lot. And yet the need to live in housing hasn't gone away. That's still, we're not going to live in our phones. The need for logistics and last mile warehouses to deliver all those goods from Amazon, if anything, that demand's going up. And at the same time, we've now seen interest rates start to come down. We've seen spreads tighten, so cost of capital is coming down. And we've also seen new supply come down in a pretty dramatic way. And whenever you get those things come together, prices coming down, cost of capital coming down, new supply, like in the early 90s, like after the financial crisis, that is a good moment to invest in real estate. And then my last elevator pitch, secondaries. Secondaries are basically interests in private equity, real estate, infrastructure funds that investors have. And because it's not a stock market, they don't buy and sell them every day. They go to secondaries investors. Because the alternative business has been growing so much, there's a need for a lot of liquidity. And so that market continues to grow. We're the largest player in that market, like we are in real estate as well. And so we can be a great liquidity provider to investors who've been through a tough period the last few years where there hasn't been as much IPO and M&A activity. So we love to find these good neighborhoods and lean in where we can.
Maybe can I ask a follow-up on secondaries? And apologies to the viewers if this is a little inside baseball, but that's grown, 7x in the last 10, 12 years. It's still only 1.5% of alternatives. Yes, you're the biggest player. I guess my question is that 1.5%, does that feel right? Should it be more? I'm just wondering. It feels odd.
It's a great question. So if you think about the stock market, about 100% of the value of the stock market trades in a given year. So if a company's worth $1 billion, about $1 billion roughly of its stock, if you took, what happens over 52 weeks. If you look in the alternatives business, it's that 1 to 2%. So it's a tiny fraction. And so the argument is they're private assets. They're never going to be like the stock market, but could you see 3 or 4%? And at the same time, the underlying asset classes continue to grow. And that's what's creating this need for sophisticated secondary buyers to come in and provide liquidity at greater scale.
Got you. Okay. So just thinking about private markets again from the perspective of the people watching, listening right now. Historically, private equity, private credit, infrastructure have been the preserve of institutions, the ultra rich. And Blackstone, to your credit, you've been democratizing access through your products. I guess first is it actually the same opportunity that the ultra rich are getting that the rest of us are getting? And then second, and maybe this is the big one, what's the framework that a retail investor should use to understand and assess the opportunities here?
Yeah. So I think if you step back and you say, why is this happening? Look at institutional investors. Think about a pension fund. If you sat down with most of them around the globe today, they would have about a third of their assets in private markets, real estate, infrastructure, private equity, private credit. Why do they do that? Well, they've earned a performance premium and they get the benefits of diversification. Okay. As they sit around, they say the S&P 500 is 40% in 10 stocks, right? Most real estate is owned privately. Most infrastructure is owned privately. I can capture that excess spread in private credit. 90% almost of companies with more than 100 million of revenue in the US are private. So they get exposure to a bigger universe, they get higher returns and more diversification. So if you look at individual investors and you look at their portfolios, they're typically less than 1% allocated. And yet their liabilities, if you're thinking about their savings for 30 or 40 years from now, their time horizon is similar. Now, you do need to say, I'm making a fundamental trade. I'm giving up some liquidity. So if you need this money to live next year, then doing private market investing for that portion of your capital doesn't make sense. But let's say this is your nest egg that you want to save and compound over a long period of time. Then it's rational to say, I'm going to take a portion, maybe it's 10%, 15% of my portfolio. I'm going to put it in private markets. I'm not going to try to trade the private markets. I'm going to establish, investments into some of these strong asset classes, hold them long-term for the benefits of compounding and diversification, just like I'm an institution.
Gotcha.
And to me, that's the approach to take. You want to get, just like an institution, long-term diversification, higher returns, and recognize that this portion of your portfolio will not have exactly the same liquidity profile. Interestingly, the innovations we brought to the market, and the reason we're the largest player, we just started a couple decades ago, but particularly 10 years ago when we started with these semi-liquid products, where you can get liquidity depending on the product monthly, quarterly, subject to limitations, that really helped make it easier for individual investors. It's still less liquid, no question, than public markets, but it's a way to get access to private assets with a little more liquidity. And also the other innovation, we took the fees down. Back to your question, Carl, back in the old days, people were charging huge premiums for individual investors. And we said, no, individual investors deserve the right to have a very similar experience to institutional investors. So bring the fees down, more in line, and make sure you deliver on performance. And by the way, that's what this is all about. Ultimately, we've got to deliver for the customers. They will be trading some liquidity away, and we have to deliver them better performance.
So that was beautifully explained. And so, Jon, I've got to ask, the videos, right? Everyone watching here today has probably seen them. It's you jogging along a boulevard somewhere, talking directly into the camera. And I guess on the one hand, it's interesting to know a little bit about the how and why you got into that. But it speaks to our core values at Finimize around, not talking down to people, just talking to them how you would a friend. And it's got the added benefit of making alternatives at Blackstone seem more accessible. I guess, the how and the why, but just how big is that opportunity in terms of making investing more human for people?
Yeah, it's fun because you would say like we had some master plan and we scheduled this out. This was much more organic. Christine Anderson, who runs our corporate affairs, was pushing me for a long time to go on LinkedIn and to connect more with people. And I went on and I did sort of the corporatist post, and it was boring and whatever. And I was in Sydney, Australia, jogging by the Opera House. And my normal thing to do was to do a little selfie to send to my wife and children and be like, hey, I'm in Sydney. It's amazing. There's the Opera House. And just to remind them I exist in case they forgot about me. But instead, this time I said, we have a lot of great clients here. We own a number of terrific portfolio companies. Australia's been through a tough COVID period. We can feel the recovery. And I talked a little bit about business and then talked about how excited I was. And we put it on LinkedIn and it just took off. And we're so smart. We're like, wow, if that worked in Australia, will it work in Tokyo? And will it work in London? And will it work in Chicago and all these different places?
Yeah.
And what we found is it resonates. And I do think there's something today about people want disintermediated connections. They want things that feel authentic. Some guy with dad vibes, jogging and, and sweating and giving some insights. feels authentic. And I
Yeah.
do think if you consider what we do at our firm, which is we ask people to trust us, give us capital, and we're going to be good stewards of that capital over a long period of time. If you can show people that what you care about, you're out there, you're thinking about the world, you have somebody who cares about their employees, their customers, and that in some
Yeah.
way they're relatable. I think that's very helpful in all of this. Will we do this forever? I don't know, but it does resonate. And wherever I go now for meetings, it includes our institutional clients. They love it. They're always like, "Hey, can we go out jogging together?" So it's become something that's fun. It was never we never expected it, but I do think there's something special about being able to connect to people sort of on a one-on-one basis in
Yeah.
what feels like a pretty authentic way. People say, like, "Do you have a camera crew?" I'm like, "No, I have my phone here and I go like this," and that's what it is. And as long as people find it interesting, we'll keep going.
Fantastic. We're coming up on time. I'm going to squeeze in one last question if I can, because a lot of people have asked me this, and I want to make sure I ask it for them. You've seen the good and the bad of markets. When you look at how both institutions and individuals, ultimately institutions are run by individuals, approach alternatives or markets broadly, what's the biggest mistake they make that everyone watching now can make a point to avoid?
I think the biggest mistake is we tend to have a pretty heavy recency bias.
Okay.
So those things that have done the best, we tend to continue to ride. Sometimes there are longer term mega trends and it makes sense, but sometimes there are cyclical downturns in assets. And there are opportunities and things that have been out of favor. I gave you the example of commercial real estate. If
Yeah.
you look at your portfolio, either privately or public markets, the last 3 or 4 years, you'd say, I don't want any part of that. And
Yeah.
yet, commercial real estate's not leaving our lives. The values are cheap relative to a bunch of other asset classes. And so you have to almost fight this instinct and
Yeah.
think about investing more like when you go to a store, when there's a sale on items you really like, you tend to be more enthused to buy. In
Yeah.
investing, it's the only world where as the prices go higher, people like paying more. So I think the
Yeah.
big mistake is to just say what has done the best and double down on that. Doesn't mean it can't continue, because there are, as I said, sometimes very long-term powerful trends like we're seeing in technology. But oftentimes some of the best investments come from things that have underperformed over a period of time. So that would be my thought on a mistake to try to avoid.
That's super helpful, and I completely agree. Look, Jon, we've covered so much. I wish we had even more time, but unfortunately we are up. So all that's left for me to say is thank you so much for sharing your views, your insights, your wit with all of our members here today. Jon Gray, thank you.
Carl, it was great. Thank you so much.